Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Thursday, February 26, 2026. The market tried to throw a coronation today, then traded like it suddenly feared a regime change. On paper, the AI heavyweight delivered. But the tape, it didn't celebrate. Nvidia dropped more than 5%, and that hit the AI semiconductor complex hard enough to pull the Nasdaq down over 1%. Here's the tell. It didn't feel like everything was breaking. It felt like leadership was getting repriced in real time. Now pull up the S&P 500 heat map. This is where the day actually makes sense. You had decent participation, lots of muted greens scattered across the board. But the visual weight? All red. And it was concentrated. Semiconductors took the dominant damage, with Nvidia as the darkest block, and the other big chip and semi-equipment names dragged with it. So the map looked mixed, but the generals and chips pinned the index-level tape down. Staying with that heat map because the money flow was the story. Capital rotated away from the most crowded, highest beta AI semiconductor sleeve after Nvidia's earnings failed to add any new excitement. That set off a very targeted de-risking in chips. At the same time, you saw ballast flows, financials were broadly constructive, and selectively software and services caught real demand, bright green islands on the screen. So it wasn't sell everything. It was reprice the winners, rotate up the stack. Here's the tension the tape did not resolve. A lot of stocks tried to hold up, but index performance got pinned by a handful of heavyweight AI-linked names. Nvidia couldn't rally on strong numbers, and the message from the market was blunt. At these multiples, perfection isn't enough. The override narrative also pointed to one specific sensitivity. Forward guidance didn't include China data center forecasts. That omission became an easy trigger for algorithmic and institutional selling. Net result, and expectations reset, not a fundamental panic, but risk appetite narrowed, and leadership got more fragile. Quick rumor check here. This is chatter, not confirmed fact. First, desks pointed at what Nvidia did not say, not just what it did. Specifically, the idea that the lack of China data center forecasting in forward guidance became a headline excuse for fast, systematic selling. Second, the broader story getting tossed around was Capex durability. Traders debated how long the hyperscalers can keep spending at this pace if enterprise monetization doesn't follow. And finally, there was talk of energy flipping into a safety trade on geopolitical headlines out of Geneva, but treat that as narrative color unless you see it persist across sessions. The market demanded absolute perfection today, and even a record-breaking $68 billion quarter couldn't stop the bleeding. On paper, Nvidia printed another historic beat, with revenue surging roughly 73%, yet the stock still cratered about 5%, single-handedly dragging the Nasdaq lower. Why did the undisputed leader suddenly turn into a liability? It wasn't the earnings. It was the scary prospect of what traders are calling Capex fatigue. The sell-off accelerated after industry reports flagged a massive gap between spending and profit. Big tech is projected to spend around $700 billion on AI infrastructure this year, while enterprise data like that much-cited MIT report suggests up to 95% of generative AI pilots are struggling to deliver real financial returns. That data was the pin that popped the expectation bubble. The algorithms ran the math. If end users can't monetize these tools, hyperscalers like Amazon and Microsoft eventually have to cut those massive hardware budgets, with just two major customers now making up more than 1/3 of Nvidia's total sales. That concentration flipped from superpower to systemic risk. The blind momentum phase is over. The market's shifting from the money-later hardware build-out to demanding the money-now trade. If the infrastructure doesn't start paying for itself, the era of easy money is done. The market tried to throw a coronation today for big tech, but it traded like it feared a regime change. Everyone stared at the so-called Magnificent Seven, but the real battlefield has already shifted. While retail traders are still fighting over tech scraps, smart money is hunting under the radar. We're seeing quiet, heavy volume move into specialized infrastructure and defense AI. Think names like BigBear.ai. Institutional algorithms aren't just buying generic AI hype anymore. They're buying the plumbing, the firms landing defense contracts, and building the unglamorous back-end systems. That's how you actually read the tape. You watch the divergence between retail noise and institutional dark pool prints. And if you blindly bought the dip in those mainstream megacaps today, you probably got chopped up. This wasn't just a domestic shakeout, it set up a global ripple that helped dictate the Asian market open. On Chinese trading floors, there's a perfect phrase for what retail just went through: Gush row, literally cutting meat, selling at a deep loss just to survive a brutal rotation. Stop being the exit liquidity for Wall Street. Track the dark pools. Watch the specialized infrastructure. Trade the real narrative. Nvidia was the switch today. The stock fell about 5.5% after earnings, even though results and the outlook were described as topping estimates, because the market treated it as an expectations and valuation reset. Once Nvidia cracked, the move spread mechanically through semiconductors and AI-adjacent names. That's why the session felt mixed underneath, but heavy at the index level. For traders, the takeaway is simple: if Nvidia can't rally on that kind of print, positioning matters just as much as fundamentals. Broadcom mattered today because it helped answer a key question: was this just Nvidia, or the start of a real sector unwind? Broadcom saw pressure in the broad chip sell-off alongside Nvidia, and that's important because Broadcom is a bellwether for AI infrastructure exposure across the whole complex. When names like this follow the leader lower, it confirms the selling has migrated beyond a single earnings reaction into the wider semiconductor trade. AMD was the clean sympathy tell. It slid as part of the semiconductor de-risking that followed Nvidia's drop. AMD is a key, liquid proxy, so when it trades down with Nvidia, it reinforces the idea this was a sector unwind, not a one-off. If you're trying to read tomorrow's tape, AMD helps answer one question: is the market still selling the whole sleeve? Salesforce was one of the clearest rotation, not liquidation signals. CRM finished higher as investors leaned into software and services, even while chips bled out. That matters because money wasn't just dumping anything with an AI label. This is the market moving up the stack away from pure hardware momentum toward application and enterprise software where investors are hunting for durability. The trade desk added a different kind of pressure today. TD sold off after a softer than expected forward revenue outlook, even though it beat on Q4 revenue. Guidance pointed to growth deceleration and margin pressure. That's important because high multiple ad tech is a risk appetite barometer. On a day when semis were already unwinding, weak guidance here reinforced the sense that the market wanted proof, not stories. C3.ai was the pure play sentiment gut check. The stock dropped after a major revenue decline, weak guidance, and a roughly 26% workforce reduction tied to restructuring and cost cuts. On the same day, Nvidia disappointed expectations in the tape. A pure play enterprise AI breakdown like this added stress to the broader AI trade, especially in the higher beta corners of the market. Looking ahead, the near-term catalyst is simple. Does the semiconductor complex stabilize, or does the unwind continue? Friday is all about post-Nvidia positioning digestion. Watch whether bounce attempts actually hold or fail quickly. On next week's macro calendar, you've got ISM manufacturing on Monday, ADP and ISM services on Wednesday, weekly claims on Thursday, and then Friday's jobs and retail cluster. No prediction here, just the setup. If semis can't find a floor, rallies in the rest of the market may stay fragile. The clean wrap today. This wasn't just sell the news, it was a maturity test for the AI trade. The blind momentum phase showed real cracks, and the market punished anything priced for flawless execution. But underneath the headline indices, participation wasn't dead, money was rotating. So into the next session, don't watch everything. Watch the semis first. Then watch whether software and steadier groups keep absorbing the flow. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.